All right, we got about a minute and a half before we are going to get things going. Tough week last week, but the week before pretty much made up for it, and I think we've got some really good stuff coming up for this coming week. So excited to start talking about it and get into what the plan is to make this back. And spoiler alert, I don't think it should be too hard. And there we go. Welcome, Petty Bourgeois, the first person to crack the seal on the Twitch chat. Glad to have you. 15 seconds until we get things going tonight. All right. And there's fridge opener. What's going on? Gang's all here, right? Uh, there is the end of the timer. I probably need a better intro to these, but welcome back to another weekly stock market stream. We are going to talk a little bit about what we did last week. We're going to talk about our plans for the coming week, where we have a very, very big amount of targeted profit, but we will get into that after we talk about some of the downfalls that we ran into last week. Mohan in the YouTube chat, what's going on? And we've got Carter in the Twitch chat. What's up, guys? Let's talk about last week. Obviously not the week we were looking for, and it's tough when stocks drop as much as they did, right? We talked about how we wanted a little bit more conservative of an approach and with smaller positions and a lot bigger cushions, because when the market falls backwards as sharply as it tends to do sometimes, we don't want to run into the situation that we did, at the beginning of the year when the market dropped 1.87% and we lost 8 grand, and then it dropped 0.26% and we lost another 8 grand. And then, the big terrible week we had the third week of the year and we dropped 23K. But since then, we've recovered a really good amount of money. We definitely could have done a little bit better at the beginning of the year, but a lot of that was, kind of my fault for wanting to ride the lightning from 2021 when we were having a really, really great year. It felt like we were playing with house money a bit. And despite the mistakes we've made, this is the chart we always want to point to, our performance against the S&P 500 since we have started doing this and publicly tracking it back in summer of 2020. So here's what we got. We have reason to believe that, we have a winning long-term strategy. There are absolutely going to be bumps in the road, but there's no reason we can't increase the lead we have right here. But step one is taking a lead on the S&P 500 in 2022, which we did not make up ground last week. So 2 weeks ago, we made up 2.01%. This week, we gave back 1.14%. But, it happens sometimes. I think the big takeaway from this week is that things could have been a lot worse. And if we had structured our portfolio the way that it was at the beginning of the year, things would have been a lot worse. And I think we would have seen another 5-figure loss on the week. Because let's take a step back. On Tuesday, I think Monday afternoon, DraftKings was up near 21 a share. I want to say it got pretty high. We could pull the chart up here really quickly to just kind of show how quickly some of these things can drop off, right? So if we type in DraftKings right there, we bring up the where's the 5-day chart? Come here, 5-day chart. There we go. It got over 21 on Monday afternoon, and then by end of day Friday, it was finishing at the lows of the week about 1640, which is, an insane move, right? It lost 25% of its value in roughly 4.5 days. But that's just the kind of market we're trading in. It's a very volatile market. I mean, this thing has had a really, really rough go of it over the last 180 days. And I think we're thankful to have a break-even price, which is now down below 20 a share. But look, when DraftKings drops this much, right, we talk about how selling the 18 strike call was a little bit more conservative of an approach. We lost 5K, but, it was one of these weeks where these conservative strikes helped us as opposed to limiting our gains. And we were able to make half of that back via call premium. So a $2,500 loss from DraftKings, and Palantir would have been a $2,000 loss, but thanks to the 13 strike covered calls, we recouped about 1,700, so we lost about 300 there. Affirm, we didn't quite make money, but for how much Affirm slid again, another one of these stocks where it has slid. AFRM. Sorry, my keyboard is not lit up. I'm just kind of punching numbers in the dark here. But another big one, right? Even Tuesday morning, this thing was trading at almost 49 a share and dropped $11 a share. And despite the huge slide, we only lost $440 on Affirm thanks to the more conservative approach that we had for it this week. And then Roblox, a 43 strike put that we sold. If we type in RBLX, this is when we finally hit right on the number, right? We had our little line drawn. It bounced off the line and settled above 43. And we were pretty much able to take home max profit on that one before rolling into next week. But another one, this thing dropped from 50 to 42. But guess what? We still were able to make $544 on it. And, kind of what we're looking at right here, this is why we do what we do, guys. Between Palantir, Affirm, Roblox, we actually only lost like $200 off 3 really, really sharp slides that we saw. Now, DraftKings, tough break, right? If something drops 25% in a week, you're going to lose money. But, again, the positive takeaway there is that we only lost $2,500. And then Fubo was another one that took an insane slide on us. Another rotten week of luck. But the good news is, look at this. This thing went from 768 to below 6 in 4.5 days. That is a huge downward slide. And, we did lose a little bit of cash on there. But we doubled down with some 6-strike puts that made us a little bit of money. Those 7-strike calls we sold made us a little bit of money. So we're banking these premiums and we're moving on to next week. And then we have a lot of these IV reversion trades, which have been really, really good to us these past few weeks. And honestly, not even just these past few weeks, the past couple years that we have been doing this. The very next video that I'll be putting out, and it's been a while since I've put out a regularly produced video. But I'm going to be releasing one this week to finally talk a bit about that IV reversion strategy, because like we always talk about, insane win rate right here, right? It's 19-0 this year, and you might say, okay, 2022 is a pretty small sample size, but if you look at 2021, the IV reversion was 36-2 with 17.3K of profit. So you're basically looking at a strategy that has a 96% win rate. It has given us $20,000 in profit over the last couple of years. And, a lot of these are very, very low stress trades. A lot of these you just, you get in, you get out. How do you find the trades? Well, we have a bot set up in our Discord server that's been very, very helpful and has given us these results, right? RCAT is a good example of one. We pulled 40 off it last week. SST was a great one. And Save, we were in and out of these for 210 and then 140. That's $350 of profit right there. And if you were in our Discord server and saw that, $350, that's some very, very quick profit. And that is enough to pay for over a year of membership to our Discord server if you want to go to hourglass-trader.com. But that is enough of the self-promo for now. Let's keep talking about last week. The biggest regret we have from last week by far has to be what happened with SoFi. We sold these 9-strike puts, and if we bring the chart up here, SoFi, it was up at 10 on Tuesday morning, and we actually tried to close these out for 3 cents a piece. We tried to close these 9-strike puts out for 3 cents a piece. However, the lowest they got was 4 cents. So this is a little bit of a lesson for us about getting greedy on a Tuesday morning trying to split hairs. The only area I'll really ever get kind of greedy on is between 6 cents and 5 cents for a closing price. And that's because with TD Ameritrade, we don't pay any commission on closing trades on options that are 5 cents or less. So there's a little bit of a difference between 6 cents and 5 cents, but between 5 and 4 and 4 and 3, there isn't that much of a difference, and it really cost me this week. Now, what we did do was we used our typical HT wheel strategy, right? And I think this is a great one to illustrate how we can effectively play defense. Because what happened with SoFi, as you can see from this enormous red candle here, was not only did it slide from 10.1 to 9.14 on Tuesday, after hours on Wednesday, there was some news that they released some future guidance, and with the moratorium on student loan interest pushed back, that did not bode well for SoFi's guided revenue. However, they only cut down projected sales by like 2 or 3%, so I thought a 20% drop in the stock was a little bit severe. I still think this drop to where it is right now is a little bit severe, and that's kind of the thesis we played right here. So if we go to this trade breakout tab, this is a really great example of how we could manage a trade that has moved against us. So off the bat, right, we sold those 9 strike puts that were going to expire last Friday. Alone, if this finished at zero, that would have made us $210. Would have been a good return. We'd have been happy. However, we would not be talking about this if it didn't turn against us. So the important thing to do is learn what to do when it does turn against you. So what we did was on the dip, we were able to actually sell 8 strike puts, and we wanted to take advantage of this big red candle after hours and big red candle off of open. When it opened on Thursday morning, it was at about 835, 840, and I figured that was a manageable price because we know off the bat when we sell 9 strike puts for 21 cents a premium that our initial break-even price is going to be about 879. And having an 879 break-even price when it stock's at 840-ish with 2 days to go, that's relatively manageable. We don't really need to worry about that too much. However, it kept sliding, and when it got down to about $8 a share, we said, okay, I think this drop's a little bit overblown. We're going to take advantage of the big drop, and not just the big drop, the big spike that you'll see here in implied volatility as it rose up from these big red candles. So with that increase in implied volatility comes increase in option premiums, meaning it's a great time to strike for selling options. So that's what we did, right? Normally, we would have waited till the end of the week and opened the covered strangle, right? Which in theory is when you take assignment of the 9 strike puts, you sell covered calls on those, and then you sell cash secured puts to kind of get double the premium, quote unquote. Now that does increase your position size, so we want to wait as long as we can to open that covered strangle, but I figured, a 2-day 20% drop in the stock was a decent opportunity to do so. So what do we know about the covered strangle? We know that when we double the position, so to speak, all that premium that we get from the second leg is a direct decrease in our break-even price. So on April 7th, we see right here, that's April 7th, when we had this initial drop on that morning, we sold the 8 strike put for 23 cents. And again, the idea is to sell something that gets your break-even price to a manageable level, right? So if, the stock was trading at 8, we would decrease our break-even price here by 23 more cents, and that gets us to an 856 break-even price. So with that, the stock's at 856 break-even price. That's okay, right? We could handle that. We could roll the 8 strike and the 9 strike another week out if things didn't get too much worse. It's still relatively manageable, especially with the amount of premium that these positions were offering. However, as things so often do, it did get worse at one point. And that's the great part about these option strategies is one, while you can try to game it a little bit and, watch the charts, try to time your entries, once you're in the trade, you're really kind of locked into the trade. And yes, you can get out at any time you'd like, but when things keep moving down against us, like on Thursday morning when they moved all the way down to 764 at the low on the week, we don't need to panic. I think one of the biggest mistakes I was making when I was using different trading strategies was that I would so frequently try to time entries and exits. And, when the market's super volatile like this at a high level, you're really just kind of guessing. And when you're guessing so often and trying to day trade things, you're going to be wrong so often. And that leaves a lot of regret because you're never going to buy at the bottom and you're never going to sell at the top. So with every single trade you make, if you're not using an option selling strategy, there's going to be theoretically money left on the table. And that's another big reason why I love our option selling strategies so much is there's so much less regret because we have defined risks and we have defined gains. So we don't really have to worry about timing trades. We can be patient, and that's what we did. We were patient. We watched it drop down to 764. Yeah, the loss on paper didn't look great, but by the end of the day on Friday, it had kind of leveled off at around 790. We were hoping it would finish above 8 so that our 8 strike puts would expire worthless. Excuse me, and we'd get 7 more cents of premium on those 8 strike puts, but that didn't happen. And again, that's okay because look, individually on that trade, we made $160 back. And that's okay, right? That's good. If we had just stuck with these initial 9 strike puts, we would have lost 850. Taking a 160 bite out of that 850 loss gets you to a 690 loss. And then we rolled into what we have for the upcoming week. And that is going to be an 8 strike put and a 7 strike put. And, you might say, okay, why did you roll to an 8 and a 7 strike put? Because, look, these don't make all your money back, right? If you hit max profit on both of these, you're not back to zero. And the answer is we don't really need to get back to zero right away because objectively, look, we were in a trade that so far has lasted a week where the stock has dropped 15.83% on us. And further, that 15.83% is calculated off that 935 stock price at the beginning of the trade. It was even higher, right? It was up at 10.1. So we're in a trade that has dropped, more than 15% just in the last 4 days. And we're now in a position where we're kind of realistically around breaking even. And that's a good place to be. We don't need to necessarily get it all back in one chunk. We don't need to roll the 9 strike puts to try to get a ton of premium at the expense of getting extrinsic value. What we really want to do is get the most extrinsic value that we can, because that helps us manage as well as we possibly can. And this is just a break-even price based off of the premium we get, right? So at max profit, if these both expire worthless, we're 150 in the hole. How do we get 150 bucks back over 20 contracts? We get 7 cents a premium. So our break-even price in theory right now is 807. And again, we can't get to 807 because our gains are capped at this 8 strike, but we could get close, right? And further, if you were to take assignment on these, you would have an even better break-even price, right? So if we ended up having to take assignment on the 8 strike puts or the 7.5 strike puts, or worst case scenario, we had to take assignment on both of those, here is what that would look like, right? So without these, we have, a $690 loss. If we took assignment on the 8 strike puts, we know that we would do that at 8 minus 0.37, which is the premium we sold them for. We know that we would take assignment on these at 763. Let me make this a little wider so we can see the history. And on our second set of puts, we would take assignment at 7.5 minus 0.17, meaning 733. So 733 plus 763 divided by 2 means that if we were assigned on both of these cash secured puts that we sold, we'd have an average share price of 748. Now, we'd have an average share price of 748 with this 690 loss, but again, to recover a 690 loss or a $700 loss when you have 2,000 shares at 748, you would really just need a 35-cent increase in the stock. So plus 0.35 means that we would, if assigned on both of these, without even adjusting the position at all, if assigned on both of these, we would then have a 783 break-even price. And again, somewhere, especially when looking at that longer term chart on SoFi, I'm perfectly comfortable with the $7.83 break-even price. And even just what we have going into the next week with 807, I think that's a very, very manageable break-even price, because the idea is that, we have this 807 break-even price, but we get to Thursday because, again, important thing to note here is that this upcoming week in the market is only going to be 4 days long. The market's closed on Friday for Good Friday. So we kind of get an extra, free day, really, of decay. And that's great because if you look at how things look, theoretically a week out. Now, these are 4 days to expiration. So theoretically, if we get to Thursday and we're trying to roll these positions, we'd see a little bit more premium. But we would know that, hey, we have an 807 break-even price. What could we do now? Okay, we could sell a 7.5 strike put. Or we could sell an 8 strike put, which would give us 30 cents of extrinsic value. And then all of a sudden we have a 78 break-even price, and we didn't even have to increase our position at all. In fact, we could take a little money off the table. So very, very manageable as things stand. If it runs back up to 9 next week and we leave money on the table, that's okay. We live with that risk, because what we want to avoid is the big loss that we potentially could incur if this thing kept dropping, and that's what we want to be able to manage. It's much easier to turn this into a profit and manage it if we have, out of the money 8 strike puts and this thing runs back up to 9 or 10 than if we didn't take as much premium as we could off the bat and this thing dropped to like 7 or lower. So that's the mindset that we want to have. But again, I thought this was a great example of, potentially scaling in, a great example of timing that increase in position and how all of that can quickly drive down your break-even price, right? Went from an initial price of the stock on April 1st of $9.35 to, as of last Friday, April the 8th, having an 807 break-even. That's a 13.69% reduction in just 1 week. So when you extrapolate that, you get some really, really nice results. And DraftKings is a great example of this, right? We've been in this one for a little bit longer. But look at this. Our break-even price has gone from starting the stock at 36, and our break-even price after selling the 18 strike. Ooh, I still have to add it here, but I already calculated it because I sold the 17.5 strike calls for 50 cents, so this factors that in. But our break-even price has gone from the end of November being 32.62 to, as of today, being 19.43. That is a 46.03% break-even price. In other words, meaning that from the time we entered the trade, we put ourselves in a position where if DraftKings dropped 46% or less, we are going to make money. Now, DraftKings has dropped 54%, but the great part about this and the great part about our strategy and how resilient it is the fact that, look, this thing has dropped 54%, yet our break-even price is still kind of hovering around the stock price. And as you can see, we can lower our break-even price every single week, right? Just over the last, even since mid-January, on average, we have lowered it by 52 cents per week. So theoretically, 4 weeks from now, we'd be looking at, if we kept that pace up of 50 cents a week, 4 weeks from now, we'd be looking at a 17.43 break-even price. And if we kept this pace up for the entire year, our break-even price would be less than zero before Christmas, meaning that we could not lose money on this overall trade despite how crazily DraftKings has dropped. And if there's really one thing I could point to about why we do what we do, this is it. Yes, it's fun to play stocks and like be part of gains where stocks go up 40% and you make a ton of money in a month, but it's equally, or if not more, terrible to be involved in something like this if you had a long position on DraftKings. And yeah, people can ride the lightning all the way up, and I think DraftKings is a great example of this. In 2020 and 2021, the market was basically moving in a straight line upwards after COVID, and I'm sure someone probably has talked all about the market and said, oh, I put money in at DraftKings at like 20 and then it ran all the way up to 74. But those people who were long investors in it, they're kind of SOL right now. They have not had a good stretch since this thing peaked at 74 in March of last year, or like mid 60s in just September of last year. In less than a month, this thing has lost like 75-80% of its value, and implied volatility is still very, very high, meaning we could capitalize off of the increased option premiums. And that's exactly what we've done to manage the position on the way down. And we talk about this in the Discord a lot, right? Our goal is to eventually, on a week-to-week basis in any position, make sure our break-even price is below the price of the stock. Now, sometimes we're not going to be able to do that, right? Like with SoFi, the price of the stock is $7.87. The lowest we could get was $8.07 without like significantly increasing our position. But it's close enough. And this is one of those kind of like quote unquote disaster situations where you have a stock slide 15+% on you in a week or less. So you kind of have to be okay with maybe being 20 cents above at the time. And this is another disaster situation, but the idea eventually is to aggressively take as much call premium as we can week after week after week. And what does that mean? It means selling at the money to get the most extrinsic value that you can. So that's what we've done. And the ultimate plan here is I hope one day, a few months from now, we're in a situation where we've driven our break-even price down below like 14 or 13 bucks a share. And then DraftKings is at like 15 or 16. And then from there, we could get aggressive with our covered call strikes. Right now, we try to be conservative, meaning we sell like in the money or close to the money call strikes, because that's what gives us these big reductions. And this right here calculates the weekly reduction in break-even price. But being conservative by selling in the money or at the money call strikes right now is what has effectively allowed us to get down below a 20 basis in our shares for DraftKings. But once we eventually get this number lower than this number, that's when the fun part begins. We've been fighting an uphill battle for sure, but when we get this number below this number, we'll be able to sell some further out of the money calls. We could really, really capitalize on a potential rebound. And in theory, what you do, if you look at this chart, there really hasn't been a ton of relief over the last, if we throw the 180-day chart up here, you tell me where you see significant relief, because this thing ran from 30, or really it ran from 20 to 64, and then it is kind of taking a straight line down. But the idea here, we drive that break-even price and then hopefully just keep playing call strikes and bumping that call strike up and up and up week after week after week. And we could theoretically play it all the way back up to like 50 if it ever gets back up there. Now, if there's a huge green candle, yeah, we're probably going to miss out on that. But again, if there's a huge green candle, it means we're probably making a good amount of money from DraftKings that week. And that's the approach that we're going to take. So that's kind of what's been going on. We've been whittling these prices down week after week after week. 2022 is absolutely been a tough year to trade in because the market has been so volatile, and a lot of these growth stock names that offer some good option premium have just been getting absolutely slaughtered. You look at DraftKings, you look at Fubo. These stocks are getting hammered. Now it's only a matter of time before I hold the strong belief that what goes up must come down. And when Fubo was in the 30s, I was screaming from the hills, I would hate to own Fubo in the 30s. But, what goes up must come down. And when things go down, they tend to have at least some sort of bounce. Like even on the way down here, you see little pockets of relief. And again, we're on another pretty nasty slide, but volatility is getting higher. RSI is getting towards that oversold area. I imagine we have some sort of relief here. And, that could really bring us to our discussion about what we've got lined up for next week. And, For those of you who watch us week after week on these streams, we talk about, what we have lined up for next week, what our portfolio is looking like. And this is probably the biggest gain that we have set ourselves up to take at a base level in a while. Typically, this number is like, $1.5 to $2.5, $3,000. But this week it is a full $5,000. And if we want to take a step back and think about the strategies that we're putting into play, why is it so high this week? And the answer is that because with the HT wheel, what does it promote? It promotes, some conservative strikes up front. Because look, if you hit the conservative strikes, $500 of profit, you're never going to be mad at $500 of profit on a trade. But if you don't, what do? Right? You increase your position size, which means you can make more money from it that week. There's another increased position right here. Those Fubo 5.5 strike puts where we entered into that strangle again. But, after down weeks, we tend to put ourselves in position for these big spikes. And if you look at our year-to-date summary, we've had some big weeks. We've had weeks individually where we've made $23,000, $17,000, and $14,000. But what you'll notice about these weeks is that they're only possible really because of these larger red weeks. So taking a step back, always trying to improve what we're doing, we said, okay, we know that, red weeks in the market are quite frankly unavoidable. We're not going to be able to avoid a pullback in the market. But what we can do is start with a little bit smaller positions. So when we do get a week that would have put us in like a 20, 23, 14, $8,000 loss position, we could scale back up and catch more of this without catching a ton of this on the front side, right? If that makes sense. And look, if the market never goes down, you'll get back into the, loop of what we did in 2021 from like July onwards, where we were just banking $1,000, $2,000, $3,000 a week from like mid-July on, and we were just cruising. And we've got some, hey, I've been looking at the chat. Clifford, what's going on? Mahir, what's up? We got Marvin in the YouTube chat. How's it going? And we've also got 18 viewers right now. So we consolidate the Twitch and the YouTube viewers. But if we get up to 30, we're giving away some Yeti tumblers if we get up to 30. And I think we will. I'll put a little more effort into growing the group and promoting the stream over the next month or so. So I think we'll definitely have a giveaway sometime soon. But that's the goal right there, 30 viewers. But again, this is kind of what we want a more regular performance to look like. And if you look at 2021, we didn't lose money a single month. And I think that's something we really like to hang our hat on. We really only underperformed 3 different months. But the months that we outperformed, we were still pulling very, very substantial returns in comparison to the market. We came home with over 100%. We crushed the S&P 500 last year. And this year, it's been tougher to trade, especially with some of like the big mistakes we made, like having a huge position in Roblox and Affirm off the bat. If we didn't have those and we properly sized those off the bat, we'd be making money on the year and crushing the S&P 500 again. However, that didn't happen. That's the reality. We learn from our mistakes, and sometimes the most expensive lessons are the best ones. And I think if you look at our performance since inception, we have one big mistake we made that we will never make again with Hyliion, which is discouraged chasing a very, very specific setup. And then there's our Affirm and Roblox mistake. So we have 2 big mistakes that came from 2 very, isolated, easily identifiable errors. But, that's all right, because even after those, even with the transparency of us sharing those huge losses, we're still crushing the S&P 500, and that is our goal in what we do every single week. So here's what we have for the upcoming week. And if you take a look at futures, they're down 0.26% right now, so it might be another rocky week. But again, the way that we evaluate these at the beginning of every week is what would our profit or loss look like if the market stayed dead flat? Because the market could go down. Yes, we'd maybe lose money. We would not make $5,000 if the market dropped. But again, the market could also go up. And then, this could go back to 17.5. Fubo, oops, that is a comma instead of a period. This could go back to 17.5. Fubo could spike back up to 6.5, and we hit max profit on both of those, and all of a sudden we're walking home with $9,000 of profit in the week. So that could happen. It could go down, but the most objectively neutral way to look at this is just if things stayed dead flat. So with Palantir, right, we sold those conservative strikes again. We got 32 cents a premium. That knocked our break-even price down another 32 cents. We're, again, slow and steady on these. We're just moving down. We could drop our break-even price every single week. The stock isn't going to go down forever. But we take at least, we're getting 640 on this no matter what. If it jumps back up to 13, that'll be another $600 we get there. A firm with 38 strike puts. This one was solid because if you look at the trade individually, right, we lost 560 on the initial 40 strike puts that we sold, and then we recouped 120 on the 35 strike puts that we sold. And this week, if it stays above or stays where it is, all of a sudden we've made $265 of profit just as long as it stays above 38. So basically, we're looking at a chart where I cannot spell. Where? I need a light on my keyboard. Note to future self. But again, over the last, 5-ish trading days, we're in a situation where we could have a stock run all the way down like this, but so long as it stays even just above like 36.50, we're going to make money despite this insane drop. So that is, again, what we love about the strategy. Roblox, we're just going to follow this thing down. We're trying to get about $1 premium per week on these things that we're selling. And the great part about Affirm, too, that I think is worth mentioning, because we talk so much about having a little bit more conservative approach in these tough markets and keeping position sizes smaller. 8 for Affirm and Roblox is what I would consider about half position. 15 would be the full position, but I went even smaller with that. And why is that? It's because I was worried about exactly what we ran into last week with Affirm, because I was worried about it falling. And if it fell, I wanted to be able to have some more money to sell some more options. So when it fell, since I had that initial position size of 5, I was able to add the 3 more to get to that half position size for me. And doing so recouped $120. And if we had sold 8 of these, we would have had an even bigger loss and nothing from those 35 puts because we wouldn't have been able to sell them. So that's the advantage in starting small. And again, we're starting small again because it's kind of right on the number there. We saw Affirm on that chart a second ago. It's at 37.33, unfortunately, after trading wrapped up on Friday. But again, that's all right. We have a break even just this week of 37.58. Wait, 36.17. I was going to say, that doesn't sound right. Our break even is 36.17 on Affirm this week. And in fact, these are our cushions, the bigger the better. And the other great part about this week, we talk about those IV reversion trades, if this thing will scroll, is a lot of those IV reversion trades come on stocks that have monthly expiry. And we've gotten some comments that say, people try to stay away from some of the ones that only have monthly expiry. But I will say, I wouldn't let that discourage you from getting in an IV reversion trade if the premium truly is jacked up. Because yes, you might have to wait a few weeks, 2 or 3 different weeks. But if the premium runs up a bunch, it's going to be equally effective. It's probably not going to go back down to 0, but you could still get that, 50% plus of max profit that we look at. And that we saw on things like SST and Save last week that made us a few $100. But again, all those IV reversion trades, MRIN, SGBX, ADGI, RCAT that we opened up, over the last 1 or 2 weeks, those are all expiring this week, hopefully for max profit. ADGI was a tiny position and could be our very first IV reversion loser of the year. But I think I may have something up my sleeve for that one. But regardless, again, if those just stay flat, that's $600 of profit for this upcoming week just off those IV reversion trades. And how do we find those IV reversion trades? Again, if you go to our Discord server, if you want to join that hourglass-trader.com, I think there should be a link on the homepage to join our Discord server. But we have this awesome bot that we've put together, IV reversion alerts. And again, it does a great job because a lot of our trades, there's a pretty wide window of when you can enter them. For example, SoFi, we lost money on this one. So even though we entered last week, it's probably an even better entry this week. But the ones that are a lot more time specific, where there may only be like a 5, 10, or 15-minute window to enter, are the things like SST, Save, RCAT, and those are going to be alerted in here. So if you are a part of our Discord server and want to be alerted to those, we tag the IV reversion alerts. If you want to have that role, quote unquote, so you get tagged, just react to this message with the diamond, and it'll give you that role so you get tagged. Next bot that we have up and is going to be tested this upcoming week is a stock halt bot, which is basically going to give you a look just like this, but for the stock halts. Because right now we have it tagged to a Twitter account that just calls out every single stock in the market. But we don't want everyone. We just want the ones with options, right? So if you actually look at our little test channel, we've got some good stuff right here. This is basically what they will look like, right? A trading halted, and then you're going to get another alert when trading resumes. You're going to see implied volatility. You're going to see range. You're going to see the reason why it, halted. You're going to see, the current price, things like that. So really excited because I think that, equally as much as the IV reversion alerts can be very, very profitable. And again, if you look at a lot of these IV reversion trades, we're pulling a couple $100 a piece off of these. So being tuned into the Discord server and having the eyes on that channel, whether it's the stock halt or the IV reversion alerts, very, very worth it. So if you want to sign up for HT Premium, hourglass-trader.com. But those are all finishing up this week. We got a credit spread that we put on SPX, basically betting that it's going to finish above 43.95, or excuse me, 4,400 this coming Thursday. That one was because, we are the beneficiaries of a short week. I thought the market was a little bit oversold at one point a day or two ago, and if we go to the 20-day here, basically what this trade does that we opened, this 4395 4400 not cash secured. I'm losing. What are we? We're only 38 minutes into the stream, and I'm already tripping over my words. The credit spread, the bullish put credit spread, means that as long as the S&P 500 finishes above, let me get my drawing tools, finishes above this level right here by next Thursday, we are going to be the proud new owners of $285. So very, very good, risk to reward right there. So if we could remove that drawing. And over the next couple days, it would take a pretty significant drop in the price, right? We're looking at the last trading month. It hasn't been this low in the last month. Maybe if we back out to 180-day, where's my line? Oh, it took my line away. But basically right here. And I like this level because, again, we have a nice little level of support right here, nice little level of resistance right here. So I do believe, yes, we could keep dropping down to this 4,400 level, and I would not be surprised at all if we drop down to that 4,400 level. But if we did, I think we'd get some sort of a bounce, so I'm happy to sell some put credit spreads right there to take advantage of that. And I do like to jump into these anytime I feel the market gets overbaked one way or another. We're still not really in oversold territory on the 180-day chart, but again, similarly to when we got overbought right here and we sold, I think we sold call credit spreads at about the 4,700 level. Let me double check what I'm saying. Yeah, we sold those and we got, $460 of profit 2 weeks ago just between those. We like to play it the other way just as much, when we think things get a little bit oversold. And if you look at the last 5 days in the market, pretty significant drop there. So we're putting ourselves in a position where you would have to drop so much further to get down to this level. But, I'm happy with how that one lines up, and that is going to be something we'll be riding for the next 4 or so days. So let's pop back to the chart, and that's pretty much everything we got for the upcoming week. And again, we always say start small. We like to target a 1 to 2% return at max profit per week, but we're in one of those weeks where we are following up a losing week. And we're now in a position where we have, some larger stakes in a lot of different positions. So by virtue of the strategy we run, which kind of naturally has a little bit of a martingale type system built in, which, kind of builds off the concepts of mean reversion in the market. Because, martingale doesn't work in Vegas because if you're on the roulette table, every single spin is an independent event. In the market, whether something is red or whether something is green is not an independent event. You can't by chance have 365 red days in a row, right? Buyers step in when things get oversold. Sellers step in when things get overbought. So things tend to follow like a sine wave type pattern. And that's the kind of thesis that we trade on with a lot of this stuff. But again, we're loaded up a little bit heavier this week, but still not too overly heavy. We still have room to add a few positions. We're going to have some buying power clear up when all of these expire this week. And then hopefully we land somewhere in the 2 to 3+%. And then we say, can we look at SI and SNO if possible? Absolutely. We can look at those shortly. Let me take a sip of water real quick. That was a very good sip of water. But yeah, this is what we got for the upcoming week. And let's take a look at, how these weeks kind of come together. We made the conscious decision right around here to play things in a way that would take a little bit of the volatility out of our account. And yes, we saw a decent little pullback where we basically gave back our gains from the 327 week. But, that really is just because we saw some severe drops. And I think the drops that we saw that gave us this with our new approach would have given us this before, and these huge drops down before. So even though it sucks that we lost 2.31%, we're off to a bad start. We're off to a red start in April, and we're underperforming the market. Look what happens if you just follow through with the process, move your break-even prices down, scale in where you could scale in, and if the market stays flat, all of a sudden we're back green overall on the month. If we actually continue to fill this out here, and I go to the right and fill the rest of these out as well, down, copy the paste the value in there, and then drag these across to update all of our tracking charts. There you go. All of a sudden, if the S&P 500 just stays flat, we have closed the gap significantly, and we are higher than where we were 2 weeks ago. And that's really all we can kind of ask for in the market, right? It's never going to be a straight line up. Conversely, it's never going to be a straight line down, but we are trying our best, with the current approach that we have in play to minimize the just absolute free falls. And let's see. And the other thing I've been tracking is the gap between us and the S&P 500 because we got off on a terrible foot in 2022. We've taken that gap from double digits at the beginning or middle of March, right down here, to just 1.36% based on that projected profit for the upcoming week. So nothing to be ashamed about there. And if we just continue this pace, right, we made up 10% in a month, and if we keep that up, we are going to get ourselves into a position that is very, very favorable, I think, by the end of 2022. So it sucks that we started off the way we did. It's never fun to lose 38K in a month, especially when it's the first month of the year and you were so excited to, keep things moving. But again, take a step back. It's just 1 month. We won each of the 2 months after that. If we look at 2021 again, look, we won every single month in 2021. We look back to 2020. Yes, we had a terrible mistake in October, which we will probably not be doing again. But again, November, December were also decently sized winning months back in 2020. So with that, we had a 14-month in a row win streak. Something was bound to give. But we're going to do our best going forward to keep those green months going into the future. And how are we going to do that? By targeting these stocks that we've got here, because they have a really, really good mix of cushion that you're able to get along with option premium that they offer, along with being stocks that I wouldn't really hate owning at these levels. But going to the chat, let's take a look at SI real quick, because Carter wants to take a look. And if we look at futures, they're down 0.42% right now. It's getting a little bit dicey out there. A little scary. What is Silvergate? I've definitely heard of this one before. If I don't know what something is, you go to the Analyze tab, you go to Fundamentals, you type in SI. And digital currency. How should I have known that this was going to be a crypto stock? So pull up the 1 year. We want to take a big look. I mean, definitely pulling back down. If we, IV rank and IV percentile relatively low compared to where IV has been historically, specifically towards the end of 2021 and the beginning of 2022. So maybe not the greatest entry point of all time from a premium perspective, but from like an actual chart perspective, tons of support at this 85 level, but I doubt you're getting much premium at that 85 level. Let's back up a little bit further, and this is always what scares the hell out of me with these crypto related stocks, because I feel like when you see big setups like this, yes, it's all fun and games on the run up. It's okay when you're bouncing off 85 and running back up to 239, but eventually I can't help but feel that when I zoom out on a chart that looks like this, that one day the music is going to stop. And if you find yourself with the break-even price, near 100 or in the 90s, and you're all the way back down to 50 or something like that, it's not a good place to be. Another example of this happening, Zillow, right? It was trading around, the 20s, the 30s. It bottomed out during COVID like so many other stocks did, and then ran up to 208. It was great. Zillow was the best stock in the world. People loved it. But after that, it fell off the face of the earth, and it is now back down below 50. And with it being below 50 and IV percentile being 96 right there, and RSI being kind of on the lower end, it's 180 to RSI looking like 36 oversold. Premium is spiking up. Zillow could be a good option for the upcoming week. It looks like they have earnings on May the 3rd, so you've got a few weeks at least of premium selling. Where can you get 1%? You can get 1% all the way down to 45 on Zillow. So if you take a look at what that would look like on the 20-day chart, 45 comes across right here. So in plain English, if you have a You sell a 45 strike put if Zillow stays above. Let me remove this one. Let me remove this one. If Zillow stays above this red line for the next 5 days, you are going to be the proud new owner of a 1% return, which if you sell like 10 of these, that's a decent number, but you'd make $470 off of 6,800 in collateral. This is another one of those where the margin is very, very interesting, very interesting proposition. So one other approach we could take is that long-term cash secured put approach with Zillow. We know that they're going to be having earnings on May the 3rd. So we wouldn't want to bring that risk into play. So maybe April 29th, if we wanted to take a look at something like that for the options, April 29th, how far out of the money could we go? We could go all the way down to, 40 or something like that, which, alone may not be the best thing in the world because 40 is still kind of in play. Maybe if something terrible happened. But the great part about these is if you go like decently out of the money, you can get that 41 cents of premium and you could get it off, $4,000 of collateral, meaning that's actually a 10% return on capital over a 3-week period. It's still a little risky for me. I like the the 45 to 60 day ones for the longer term cash secured puts, but decent options Zillow, especially where it's sitting at right now. I don't know if I want to get involved in real estate, but just throwing some ideas out there. I don't know if this will be one that I personally take. The other stock that Carter wanted to take a look at was Snow. Let's take a look at Snow. 208. We did play this one, I think, when it ran down a ton. Let me pull up the 180 day. Yeah, we played it off of this enormous red candle because you run into the position sometime where, yes, implied volatility runs up at earnings. And then after earnings, you'll see it drops off. You'll see after earnings, it drops off a bunch. What was interesting with this one is sometimes you'll get earnings moves that are so large that it doesn't quite drop off right away, right? If we zoom in here, you don't see it immediately drop all the way down. You see this big red candle, and then it drops off a little bit. So that was what we took advantage of with that. But again, look, you could look back just to mid-March right here and see that this thing was trading at 164. I think this definitely falls in the conversation of stocks that have run up a bunch, fallen back down. I mean, let's see where this thing was pre-COVID. Or did this one IPO post-COVID? It did IPO post-COVID. I don't really have an opinion on this one as far as like a stock ownership perspective, but as far as an entry point, if you were going to sell some cash secured puts to try to initiate a little bit of a position, it's oversold. IV is getting up there. If we go to the 1 year, what is it? 72 is the IV percentile. So IV rank of 45 implies that, it has spiked higher in the past, but in a general sense, that IV percentile is 72 would imply that it definitely has some room to keep falling off. But again, it has fallen off a bunch just in the last, month or so. And I don't know if it'll get back down here, especially, anytime soon with how it's been trading. But if you wanted to, follow through on that process and, you look, it's got weekly options, which is always great from a flexibility perspective. Where can we get 1% ROR on a weekly basis? The answer is 192.5. That's, got to be honest, that's really not a bad number if you wanted to initiate a position here at 190, right? That's a great place, I think, to be in at. Oh, where's 195? Yeah, right about here. So, I mean, not a bad place. Very, very big cushion. But again, it's easy to say, selling a 190 put on a stock that's 208 is a big cushion. But if you could have said, selling a 220 put on a stock that's 246 is a great cushion, then all of a sudden it gave $40 over a 10-day period. So that's one that may be a little sketchy. I'd maybe wait for like a big red candle like what you saw on Wednesday morning with this one. So if you keep this thing on your watch list and you see, oh my gosh, it just fell off the face of the earth this morning, that might be your cue for entry. And I'd imagine you'd probably be able to get 1% down in like the 185-ish area. Carter's saying he likes the 195. For me, I think anywhere in that range, right? Because you're getting around 1%. So, I don't hate that range, to be honest. I just don't know enough about the stock. I don't have strong feelings about owning it, but if you did want to own the stock, yeah, that 195, 192.5, wherever you're getting that 1% ROR seems like a decent deal. In talking, since we did have a little bit of red in the market, it looks like we might have some red in the market tomorrow when we open. One thing that we didn't quite see when we ran our scans last week, because it was a green week 2 weeks ago, were some of these intersected, these intersected scans. So what we like to scan for normally, if we load up our scan queries and go to HT oversold or high ROR puts without earnings, this is our basic scan. And this is going to tell us objectively the highest premiums on cash secured puts over the entire market on things that are out of the money. And I am in the stock hacker, which is not where I want to be. So let's go to the option hacker to bring options up. And there you have it, right? I mean, there's some crazy stuff, right? There's SST, which is offering 25% ROR, which is obnoxious. And SST was one of our IV reversion trades that we did earlier this week. Why did we love SST for IV reversion? Answer, they had good earnings, so they spiked way up. And they went from 16 up to 30. And what that allowed us to do was actually sell like 15 or 16, I forgot what our initial entry was, but like 15 strike puts for like 20. I could, instead of just bullshitting numbers here, we sold those 15 strike puts for 36 cents. So this huge spike in implied volatility helped us a ton because it let us enter with a break-even price right around here, which is where the stock had historically been trading, even though it had already jumped to like 30. So these IV reversion trades are a super, super fun way to play some of the high-flying stocks without risking kind of losing a ton of money and having a very, very manageable break-even price. But we're not going to continue with SST because it's a former SPAC. And why did it make this move, right? This is the classic chart that we look at. You have a $10 net asset value on a SPAC, so it means pre-merger really can't go below that because that $10 a share is just held in cash, and the value of cash really is not going to change pre-merger. So you see that, and then you have the merger, and that $10 net asset value, that $10 price floor is off the table, sinks down to 7.7. But what happens with some of these worst SPACs is at the merger date, you have the option to say, okay, the holding company, the SPAC, has chosen to merge with X company. Do I want to have these shares of X company, or do I want to redeem the shares I have of the SPAC for just $10 and get my money back, basically? And a lot of the time, if you are holding shares of a SPAC and you think, oh my gosh, like this company that they're about to take public is terrible, you're going to redeem your shares, right? You're not going to want to be holding shares of a stock that you think is tied to a bad company. So if you get a bad enough company, a lot of people are going to redeem their shares. So what does that do? It takes shares out of the market. So when there's a lot of shares taken out of the market via redemption, there's a very low float, which for those of you who are familiar with like these short squeeze theses, when there's a very, very small amount of shares trading, it is very, very easy for a lot of buying volume to make the shares shoot up. So what I see from people who don't really understand what's going on with a SPAC merger, and we've seen a ton of SPAC mergers, for those of you guys who are in the Discord server with me, I feel like we're almost SPAC experts at this point. But when you see something like this, a lot of people say, okay, they had good earnings, it spiked up, I think that this stock is going to be great and keep running up. You are wrong, because eventually with the way that the equity structure is on a lot of these SPACs is, while yes, right now so many people have redeemed their shares and there are not a lot of shares trading, the way that they're structured is one day a bunch of shares are going to unlock. Whether that's via a PIPE investment where investors are then allowed to sell their shares, or whether it's via exercising warrants or something like that, there is a day down the road where more shares will be released in the market and this thing is going to absolutely free fall. Now, we don't quite know when that date is going to be. It was speculated that it was going to be this coming Thursday when warrants are going to be exercised. But I think I did a little research, and it turned out that I think they filed some sort of filing. Obviously filings get filed, but they put up a filing where I think the SEC has to review, which may extend the timeline. So you might see this one get talked about this week. But let me ask you, if we know what we know about SST and we know that this thing is going to come back down in a terrible way eventually, why would you ever set up a bullish position? If you are setting up a bullish position on a stock that, you know the logic, it's eventually going to go down, but you want to catch a little bit of a spike, why are you playing a position up on something that you know is going to go down? There's so many other stocks out there. There's so many other options on the market. There's no need for you to chase something like this. And it's great up front when you could catch that initial spike and you catch this huge initial jump in implied volatility and you're able to cash out $210 like we did. That's great because we have assurances that the shares aren't going to be diluted until at least like the 14th. That's great. But beyond then, yes, it's great to look at this and say, oh, these things are offering insane amounts of premium, right, Jack? Like, you could get your 1% ROR at, an 11 strike, at a 10 strike for the coming week. That's crazy. But if all those shares get unlocked and this thing starts falling, you are going to wish you never owned those things at 10. And it's where the risk reward at these levels is very, very skewed. Off the initial jump, when you can get in at this level with the very short time frame until expiry, really not worth, or it's worth it then, but right now the risk reward is very, very skewed. This thing could end up like several others that we have seen. IRNT, if I could hit the NT. There you go. Very, very similar pattern. A huge spike up, a huge fall back down, and then people might say, hey, oh, it's coming back up, but what do we know about these SPACs? They're going to come back down once the equity structure is fully out there. And it's now down at 265 at the low, trading at 330 off a stock that was trading at 60. And again, this is just a 180-day chart, right? We're looking at just September of last year. $60 to $3. And that's in just like 6 months. This isn't the only one. We see SPIR, 195 after jumping very similarly to SST. It went from 10 to 19.5, and then you have the days that the equity is released into the market. All these shares flood the market, and everyone sells off, and it gets down to 162 at the low. Maybe something even like RMO, where it jumped up, and I have to zoom out even further to see the big spike. If I have to, hold on. There you go, a spike up to 38.9. Does that look familiar? It looks very familiar to what we just saw. But yeah, this is why I would caution you not to get in the way of this, because this thing's now trading at 140. Insanely low. And that is really, it's going to happen again to SST. I'm very, very confident. And you might say, look, HT, if you're so confident that this thing's going to fall back down, why don't you just buy puts on it? And the answer is because you would need it to fall a ton. Like if we look at RMO, it peaked on December 28th, and it didn't get back down below 10 until April the 12th. So, that's a pretty long way away. And if I went to SST and I pulled up the options 4 months out, which would be what, like August, and I wanted to sell a 10 strike put, those are $2 of premium. Those already offer an insane return. And in fact, there's a reason that even the 5 strike puts are offering 7% for August. It's because it is very, very likely that the stock gets back down there first. So that is why I'm staying away. And you might also say, look, well, if RMO took 4 months, why don't you just sell a 10 strike put that expires this week? Like, why don't you do that? Because we can look back at something like SPIR, where there was just one big red candle that took it all the way down to 7, and it happened in the blink of an eye. The idea is, look, we know it's going to go down. We don't know how fast or slow it's going to go down, but there's just no reason to take unnecessary risks in the market. Question from Petty Bourgeois saying, how do we feel about DB or M for weekly cash secured puts? And I don't know. Let's take a peek. DB, what is DB? Deutsche Bank. Here we go. What do we know about Deutsche Bank? Why are we asking about these? Throw me some context in the chat. What do we like about Deutsche Bank? What are we looking at? From the 1 year perspective, let's use those little think scripts that we have on our charts right here. IV rank 49, which means, yeah, IV has been a lot higher, and you can very clearly see that on the chart, right? This drop from 16.7 to 9.46 is going to create a lot of volatility. So that is why IV rank is low, because it's about half of the height at the peak. But IV percentile is 91, meaning 91% of the last 252 trading days, and there are 252 trading days in a year, IV was lower. So yeah, I'd say there's a bit of an opportunity for getting in at a decent level. It looks like this level right here provides some very, very good support, long term over the last year, and this comes in at about $12 a share. Now this thing clearly ran into some other issues as it got down to 9.46 for I don't even know why. I haven't really been following Deutsche Bank. Interesting. Yeah, no, great point there from Petty Bourgeois saying, look, like it's trading back in that pre-trading range. That's exactly what we're identifying with this line that we throw on here on 12. So maybe selling some 12 strike puts is a good thing to have. So from February to March, it had a huge slide. The very first thing we want to do before we think about potentially initiating a position here is figuring out, okay, why do they have a huge slide? So we go to live news. We go between February and March. And what's happening here? What's happening between February and March? Down 12% here. That looks like it's just a headline with stats. It doesn't really say why. Russia-Ukraine conflict, sanctions on Russia. Move shares of banks lower. Looks like this is really kind of war related. Yeah, I mean, I think I could. When did this thing bottom out? About March 8th. Okay. So then it looks like they released some very, very future guidance, FY25. I don't even know why why they'd be doing that. I don't know if they have any price targets released lately. I'm not really sure. If we go to the Analyze tab, another cool thing here, if you type in DB, there you go. Some of these things will rate the stock for you, right? Neutral, hold, 4 stars. That's all right. We've definitely seen worse, and I think this is a good place to start looking about ascertaining the quality of a stock. But again, we looked at that chart. We said, okay, 12 looks decent. We know the reason why it dropped off was largely war related. Looks like they may be coming up on earnings. So one quick way to check that is to type DB into that watch list down there. DB, click that icon. April 27th. So we've got 2 weeks of selling options on this thing before we have to worry about earnings. So let's take a look at the 12 strike puts, and they offer 1%. I got to be honest. I'm a fan of the Deutsche Bank 12 strike puts because further, we love to use that that market maker move of 31 cents. That would put the low end of the range at 12.50. Even the expected move of 70 cents would put the low end of the range at like 12.11. I am a big fan of the 12 strike puts, and if you could get 12 cents or better, I think that's a great entry. I think that's a great suggestion. Definitely one I think I'm going to keep my eye on. And yeah, look, obviously start small because we've seen that there could be downside at 908, but it's not the worst thing in the world to own a large financial institution as opposed to some of these other, more volatile stocks that we've been playing. You could maybe even try to take advantage of the slightly heightened volatility. I think down here would have been a much better time to take advantage of it. But let's look about 45, 60 days out. Let's see what we can see. It looks like 47's in that range. And we could get 10. I don't really like what I'm seeing right there. One, there's like 0 volume. If we go to July, that's like 100 days out. That's very, very far. Not a ton there. Well, the hope was I could maybe get a ton of premium at like the 9 level and be confident in the fact that if I got assigned, that's okay because it'd be at a 1-year low. But yeah, I can't really get as much as I think I would want. Although huge margin privilege right here, right? Normally it would take 87.50 fully cash secured. This takes $900, meaning you get roughly 27% ROC. Very, very good number right there. Let's see what that would look like on a weekly basis. Yeah, huge margin privilege on a weekly basis as well. Does not cost a ton to open those puppies up. So I think that's one I'll probably try to give a shot once the market opens tomorrow morning. The other question was on M, which I think is Macy's. Macy, where are you? Here we go. 23. This one scares me a little more just because I know where it's been. If I zoom out, I think I know what we're going to see. There you go. 438 at the base of the pandemic. And it looks like, yes, it's trading around this 22-ish level of support. But I could very, very easily see it getting down to 17-ish, 16-ish. Reminds me a lot of what we saw with Fubo when it was running up. And yeah, it had a little bit of support in the 30-ish range, but there's this little shelf it was trading before it broke out, and it got back down and below that shelf. So not a big fan for at least what we do of entering at these levels for Macy's. But yeah, there's decent premium. I mean, you can't even get 1% at that 22 range. I don't think I would touch this one, but I do like that Deutsche Bank suggestion. Back to the scan, we see SST. We talked about why that's not a very good idea. SGLY. Let's see what SGLY is. Singularity. Oh my goodness, this is insane. One, we just talked about bad-looking charts. This is one right here. But I am insanely curious about what has happened just during this. Singularity, what is it? Oh, it's a Chinese company. It looks like. Huh. I don't think that, I don't think that's something I'm very interested in. One, being a Chinese company, and two, this huge jump from like 2 to 19. Fun to look at, sometimes, look at that. You can get 10, you can get 10 cents a premium at a 5-strike option. And it wasn't trading at 5 since February. Okay. All right, we may have to make an exception here because this is absolutely insane. Why did it go from 19 to 12 on Friday? Oh my gosh, the news is from April 4th. If we look, what was that? We started with the 180-day chart, didn't we? How about the 20-day chart? Yeah, I mean, look, I don't think it's the safest trade in the world. Let me preface it by saying that. But if you can get 10 cents a premium in here, and you're absolutely going to have to sell these things fully cash secured. But if you can get 2% ROR right here and kick it off with the 490 basis and get a 10 cent fill, not the worst thing in the world. I mean, I hate that I'm even saying that. I mean, if you did take this one on, take it on with the knowledge that it is insanely risky. But again, huge spike in implied volatility. Oversold. I mean, a $7 candle down basically on a daily basis for that stock. Might be one to keep an eye on, SGLY. Interesting. Very, very interesting. Let's see what else we got here. MULN. A lot of interesting names coming up here on the top because this one's popped up on the IV reversion scanner. We're going to take a look at a few more of these, then we're going to do the old intersect feature to try to find some home runs right here. So let me think. What am I looking at? MULN. That's what we were talking about. MULN. Mullen Automotive. This one has been talked about a bunch because it's almost like a meme stock in a sense. Because a lot of people have been talking about it on social media. It bottomed out at 50 cents right there, which I don't love that at all, right? And this is when it came on the IV reversion scanner. It had this huge candle, the huge spike in implied volatility. We got tipped off to it. But when you take a look a little bit further back, again, this is just a 180-day chart. This is not like a 3-year history of the stock. This thing has been absolutely wild. And even just back in the beginning of March, it was trading less than $1. So that's why we didn't enter in. It's way, way, way dangerous. And really, you can't get any premium at any sort of meaningful level. I mean, maybe if you wanted to try to go a month out and get a one-strike put, but even then, like it could still get below $1. It has definitely demonstrated that. But good example of the fact that just because something's on here doesn't mean it's necessarily a great investment idea. Really important to go through the process, do the diligence, take a look at the chart, and figure things out yourself. Let's do NRGV, and then we can move on to some other stuff. NRGV. Never heard of this one before, but NRGV. Let's see what it is. Energy Vault Holdings, and yeah, a lot of these that are super, super high on this are going to look like this. This is the 180-day chart. I guess it only started trading in February, huh? Interesting. Makes me wonder if this is a SPAC, and the way to figure that out is going back to February, looking at the news, and there you go. There you go. When you see like Capital Corporation or like Holding Corporation or something like that, that means it's going to be a SPAC merger. So we don't want anything to do with that because we just went on a little bit of rant about why we don't like SPACs. And there is a ton of premium on this because of the volatility and downward pressure on SPACs. One other thing that I thought might be interesting to kind of help parse through some of these, right? Because when we have this very, the vanilla high ROR put scan, we have 962 different stocks or different options that come up on here, rather. I thought it might be interesting to put a percent out of the money thing on here to see, how far out of the money on some of these can we go and still get 1%. And if you take a look at, Etsy is on here very interestingly. Let's take a look at Etsy. So there you go. I mean, Etsy has been through the ringer. The low of 106, I mean, it's starting to approach this line right here. Again, only a 180-day chart. I mean, a lot of volatility on this thing. At this current price level, yeah, it quickly dipped down below here, but it looks like they had good earnings back in February, which bodes well for the stock. Looks like a little bit of support here at the 115 level, right where it's trading at. I don't think maybe sliding it with the 107 strike put is the worst thing in the world here. And according to the scanner, we can get a very, very big cushion on these, right? And this isn't just some BS result, right? It's a very tight bid-ask spread. There's volume on it. We could get something here. And if you look at the MMM, it's $6 for the upcoming week, meaning the low end of the range is probably 110. But we can go a little bit further down to 108 and get that 1% ROR that we like to get on a weekly basis. However, 108, I don't hate that 108 level. But I do wonder if we look at the news, because volatility is spiked up on this one a little bit, but it has that beautiful intersection that we like to look for of being oversold and having volatility spike up, because it means you could slide in way below the cost of the stock and still get decent premiums. And typically when that happens, what that tips me off to is saying, hey, maybe open a long-term cash secured put, but let's first look short-term. We can get that 1% at 108. Kind of 50-50 on that. Very, very decent margin privileges. But let's go to that 45, 60-day range. Let's look at June. 68 days till expiry. And you could get on to 70, 75, even 80. Get, $2 a premium right here. And the idea behind these long-term cash secured puts is going to be that you want to, what am I saying? I started the sentence without knowing where I was going. You want to use margin here. Because by itself, look, getting a 2.83% return between now and June 17th is not very significant at all. But having a $36 cushion on a stock over the next 68 days is, very, very big. So how do we bridge that intersection of, having enough premium to give us this kind of a cushion while not really liking the ROR? And the answer is leveraging that capital, right? So if we sold 2 of these, normally it would take $15,000 to sell this fully cash secured. Instead, it only takes us about $1,600 to do that. And we know that if we make $440 off of $1,600, that's a 25% return on our capital in just 2 months. So if you look at that, look at 2 months as like 8 weeks, that's like 3% a week on a trade. And we really only like to target 1. And you're getting that return so long as Etsy stays above, where's 80? Where's 80? So long as it stays above here. And I think historically, if you take a look at like the 1 year and even the 3 year on this thing, that's probably not the worst place in the world to be, right? The COVID lows were 30. We've seen a lot of stocks retrace this move back to the pre-COVID highs, but the pre-COVID highs were about 65. So maybe it's a good idea to hold off a second and not really, let me think. Yeah, I don't want to fall into the same trap. The big issue I had when I did this with the Furman Roblox was the fact that I sold way too many up front, and my fully cash secured position was enormous. Because if you look at the Roblox chart, we were in a position where we were basically looking, if you to the 1 year, we were looking at something like this to say, okay, look, it's run up a ton, and it has since fallen back down, but look, we could get a break-even price around like 50, and if we get a price around 50, that's really good historically. But, the valuable lesson learned there is things can always get worse. They could drop so far down on you, insanely far down on you, and we always have to keep that in mind. So we want to keep the position small. So maybe if I did do this Etsy trade, this long-term cash secured put at the 80 strike, only 1 or 2 contracts of that fully cash secured, it would only represent about 10% of my account. I think that's a good place to start. It's a good trade-off between making 25% ROC over a 2-month period, and at the same time not just losing my ass like I did with the Furman Roblox in case the market really does keep moving down. But that's the value prop with those long-term cash secured puts. That's why we do what we do with those. And honestly, I don't really have any. I haven't had any since we closed out Facebook. Facebook went well. Snow went well. Shop went well. I like the idea of adding some of these. And my favorite way, fantastic segue into this, my favorite way to take advantage of this is, or I guess identify these opportunities, is to use the intersect feature, right? We have our high ROR puts without earnings scan. And if you intersect, because this gives us like the highest premium on the market. But how do we intersect high premiums, high premiums right here with like the oversold opportunities that we see on something like an Etsy on a 180-day basis? Like we mentioned earlier, we love the spike in premium combined with the drop in RSI. Why do we like that? Let's take a look at the 180-day for Shop to show us why. Because the last time we saw this big spike right here combined with a drop in RSI, it ran from 500 back to 766, and we were able to cash out on that one very, very nicely. So we have our scan here of 962 stocks. How do we find the ones that look good from an RSI entry perspective? We use the intersect feature, go to our personal, go to HT oversold stocks, and scan. And we go from 962 results to just 7 results. And I love this one because it's a much, much more focused scan. Like when we did this last week, nothing came up on here because you're not going to have great results all of the time. And in fact, just because something is on here doesn't mean it's a great result. We still have to do our due diligence. But we have 1, 2, 3, 4, 5 different names that we can do this on. And I think it's about to be a very good exercise. And we will end the stream with this quick exercise, playing a game of should we sell long-term cash secured puts on these. So NYCB. Here you go. The classic, setup, the spike in implied volatility, the drop off in RSI. This is exactly what we look for in a long-term entry perspective. We've got the 180-day chart. 10 seems like a fantastic price to own this. It's another banking stock. If we back up to the 1 year, how bad can things get? We're at a 1 year low. If we go to the 3 year, okay, it looks like we can maybe get down to these 950-ish levels. I think maybe 9. We've definitely seen November of 2020. Interesting. The COVID low was just above $8 a share. So we would use this information to say, okay, maybe $8-ish a share is a good spot to be in on this one at. So we try to go 45 to 60 days out because the theta decay curve is a little bit different when you are further out of the money. So when you're further out of the money, it actually starts to ramp up a little bit at the 45 to 60 day till expiry window. Unfortunately, we don't really have that here. So maybe we look at the 40-day window and say, okay, we would like to own it at 8. No volume at 8, right? If we look at April, there's not a lot going on right here either. And to be honest, there really isn't a lot of premium or a lot of price movement priced into these things, right? If we look at the last 20 days, we see the things slid from 1137 to 1002. The MMM is telling us there's only a move of plus minus 4 cents. And even the expected move, which is usually a lot more overstated than the market maker move, is only 27 cents. So even if we got to July, can we get some premium here? I mean, first off, there's not really any volume. So I don't really know about that. Some seriously nice margin privileges right here. But again, no volume. You can't really get a ton at these levels. I think I'm going to leave this one alone. And that's okay. Not every one of these is going to be perfect. So we go to the next one on the list. And the next one on the list is PFSI. What is PFSI? Let's take a look. PennyMac Financial Services. A lot of these financial services companies, what's the deal? And I imagine it's probably very similar to what was happening with SoFi, where these things are kind of falling off the face of the earth because they rely a little bit on student loans. Price target cut to 65. Obviously not very good. Cut to 98. But again, these are stocks where these price targets are very, very high. So, at least a lot higher than where it's currently trading at, 47. So at least there's decent upside there. They presented earnings at the beginning of February. I guess they weren't catastrophic. Let's back this thing up to the 180 day. Let's go through the process, right? It's fallen off a ton. Implied volatility has ramped up a very, very big amount. Let's see what else we've got going on right here. Go to trade. And here we go. Where would we still haven't really ascertained where we would want to get an entry at. If we go to the 1 year chart, what do we see? We see that big spike in IV, but we still don't really have any support that we could point to. It's really kind of a no man's land, and this is what scares me a little bit on the 3 year chart when we go to it. We have pre-COVID highs of like 36. It bottoms out at like 16. This is not maybe these pre-COVID highs of 34 would be where I want to own it. But again, we don't have any options in that like 45 to 60 day window. This is the closest we've got. Could we own it at 35? We could, right? We see some premium on those at 35. But again, I think we'd have to battle an earnings, which could be a very, very volatile event. And if we get 55 right here at the mid, we still get that nice, margin privilege. But again, it's nothing like that 25% we saw on Etsy a little bit earlier. Don't know if I'm in love with potentially owning this, especially when we see COVID lows of 13 a pop. Just not a great one for us. Sava, I can tell you this one's not going to be good for us because I already know what it is because it has been so volatile. This is like an Alzheimer's drug biotech company. Even on the 3 year, we look back, this thing was trading at 1. I mean, this thing was trading. Why my y-axis is going negative because it had been previously trading so low. But spent a very, very good amount of time below 10. I mean, really no reason for you to risk going, yeah, risk anything on this, quite frankly. I wouldn't, definitely don't think this is worth it. And I think you probably have to sell these. Yeah, you can't really get a lot of margin. 9,300 compared to 16,1 fully cash secured. Not a good option. Then we got 2 more that we can maybe get a little bit of redemption on between Tex and UPS. Can we get a good option? Let's see. Tex is Terex Corp. Right off the bat from that 3 year, we see those very, very similar price levels to what we saw with the other one. What was it? PFSI. 55. Now trading at 32. But again, at least it's now kind of in that area of pre-COVID highs that we've been looking at. 30-ish looks to be the pre-COVID high before it fell down to 11, which is a little bit scary. But pop into that 180-day chart. We see implied volatility is kind of higher. I mean, it's not through the roof or anything like that, but it's definitely oversold from an RSI perspective. And again, why do we love RSI? The last time it got down into the blue, this thing bounced from like 35 up to 39. Last time it got in the blue before that, it bounced from 40 up to 47. And again, it got in the blue and bounced from 41 to 46. But this is why RSI is one of our favorite technical indicators and why anytime we see something go into the blue here, we kind of like to pounce. So we've identified the 30s as an okay level to jump in at. I think maybe the bottoms of these like waves right here at this level and this level, kind of low to mid 20s, would be a very good place to own the stock. But again, you don't really see anything in that range. But not a ton of volume, unfortunately, as well. Maybe 28s for May 20th. I mean, do we even get margin privileges on this? We really, really do, actually. I mean, this is about a 20% return if you were to sell these. However, 28 giving you a 27.5 break even. I mean, it's decent, don't get me wrong, over a 40-day period. But when you've got something over a 180-day period that's gone from 55 to 32, I just don't think 28 is enough of a cushion for me. So I think I'm going to stay away from that one. I mean, if you look at the news, I'm sure they've been downgraded. 57, 44 right here. If we go to the analyze one, I guess, I wonder if we get anything on here. Text. No, nothing right here. So they don't even have, oh, they do have it rated. We have a buy from April 3rd. We have an avoid from April 8th and a hold from April 10th. A whole lot of useful that is. But again, not a home run, so no reason for us to do that. And I think this thing, similarly to how when we looked at this last week, last Sunday, and there weren't really any results, this thing tends to light up with some very, very good investment opportunities when the market is red. So if we run this again tomorrow at some point, we might see some very, very good potential entries. But again, last one on the list, UPS. That's surprising. Normally solid stock, and there you go. This is exactly what we're looking at right here. So why is it dropping so much? It's dropped from, March 30th is what we're looking at right here at 222 down to 191. That's a huge skid. What has happened since March 30th? Let's see what we got going on right here. Apologies as I try to figure out what is going on right here. Shares of companies are dropping due to the rate hikes. That seems pretty severe. We have a price target cut to 229. Again, it's at 191, so nothing too bad with that. 204. It's not the greatest. And then we see 229 again. I think that's the same one as earlier. Yeah, it's the same one there. But we have 229, 204 price targets. Last 180 days, we see 180 as downside. Let's get back to the 1 year. Again, this 180 level looks fantastic for support. You have two gaps kind of down to it. Pretty big gap right here. But I think 180 is a really, really nice support level. Let's go to the 3 year, see what we've got. Yeah, that's scary because it fell down to 82 at COVID, and the pre-COVID highs are like 120. And I would think we have a couple initial levels of support, right? We have 180 that we first called out, and then we have this second level of support, which is, right where these have been bottoming out at about 160. So if we go to the if we go, we got Conspicy in the YouTube chat saying nice scanners. Thank you. Thanks for watching. But we've got two levels of support we've really identified here at 180 and then 155-ish. But this one, a lot more options on here. We could get that 45 to 65 range with the June 17th, 2022 expiries at 68. So can we get, first off, anything at 180? And 180 is, admittedly pretty aggressive for this one. I think in the next 68 days, I don't know if there are actually going to be earnings in the next 60 days. I would say probably, because their last earnings their next earnings should be in May. So this will definitely incorporate an earnings trade. But then 155 is maybe what we would want to look at below that. And that's really not too bad either. Like if we can get, some very, very nice margin privileges. And at 150, I'm not going to sell 10 of these and give myself a $150,000 fully cash secure position. But if we sold, just one of these, that's $1,500 of buying power. And $200 of profit. I mean, that's still not 25-ish% ROC or anything like that. But 155 seems like a phenomenal level to own this stock at in the near term, right? The big jump up was at the end of 2020. So if it dropped back down, it could get back down to 120, which would be a little bit scary. But let's see. Carter in the chat for Twitch is saying that the stock is said to be going down based on Fed and trucking issues based on carrying capacity. Definitely could make sense, but look, with the price targets we just saw from two banks, both above 200, 180 is a little bit sketchy because there's definitely a little bit more downside there. There's an earnings report coming up. But if you went at 180 and you sold two of these puppies, you'd be absolutely cruising because that's pretty significant. It's like a 30% ROC right there with a $1,400 potential profit if I were to sell two of them, and that would be owning UPS with the basis of 173, which would stick us right here on the chart. Not a bad place to own the stock at. However, there is earnings, but implied volatility is up. The idea is you sell something a little bit further out of the money when IV spikes up like this and try to quickly get out for 50% of max profit. I think that lends itself to us selling these 155 strike puts for a little over 2 a pop and then trying to get out if they drop back down to 1 a piece. And again, what could get them back down to 1 a piece? If UPS jumps up $15, that's what gets them down to 1 a piece. If implied volatility drops back down to more normalized levels, that could significantly drop them off, right? If we're looking at the 180-day chart right here and looking at implied volatility, huge spike off this downturn. RSI is in the red. And again, RSI is in the blue, meaning oversold. Last time RSI was in the blue, we got a jump from 197 up to 211. So look at that. I mean, that's your $15 move right there to get you back to what we want from a profit perspective. But here's going to be the game plan. We're going to sell a couple of these puppies, aiming to get like 225 a pop at max profit by June 17th. That's $454 off $3,000 in collateral. If we bring up our handy dandy system calculator here, what you're going to see is 454 divided by 3101. That's a 14% ROC. And it's a 14% return over a 2-month period, which if we assume that's like 8 weeks-ish, that's like a 2% return per week. So that is right in line with what we like to look for. And that's off $3,000 of collateral. So you put that in the back of your account, you let it sit. But again, the idea is we get out for 50% profit in like 2 to 3 weeks on this one. And if we get out for 50% profit, we're making $225 off of 3101 in a 2-week period. All of a sudden, that's 7% return in 2 weeks. That is a phenomenal number. So that's kind of how we play these. We don't necessarily need to take these all the way down to the wire. But the idea is 2 weeks from now, when this thing goes from the 60 days to expiry to 45, and you've moved through that period of accelerated theta decay on options that are further out of the money, you should have a decent little setup. And if not, if shit hits the fan and this thing keeps dropping down, at the end of the day, we've got 2 sets of stocks, 2 lots of stock at like a 153 basis on UPS. And if we're looking at the 180-day chart, that means we would own it at this level right here. That is below both of the outlined levels of support, and that is not the worst thing in the world at the end of the day by June. So that is how you use volatility to your advantage. That's how you intersect, like when RSI drops into the blue and volatility is jumping up. That is why we love this scanner right here. Yes, it gave us 1, 2, 3, 4 options that we didn't really like too much, but it gave us 1, 2, 3, 4. Yeah, it gave us 4 we didn't like, but it gave us that fifth that I think is a really, really good opportunity. And you're not gonna crush the market by taking home $400 over a 60-day period. But the idea is you find more and more and more of these. You don't just have one open. You have 3, 4, 5, 6 going at a time with smaller contract amounts, and those amounts compound into really nice gains. Like if you have 10 of these going, okay, that's now $4,000 that you're getting headed into the summer, as opposed to 400, and you can move in and out of these as you please. And again, if the market drops 10% and UPS falls 20%, oh my gosh, how terrible, you'd still make money. These big cushions are how we navigate the volatile markets, and I think UPS long-term cash secured put, along with Etsy maybe, are some good ones to add. So we've hit the 1 hour, 30-minute mark. This is what we've got for the week. Yeah, we talked about some new potential options with long-term cash secured plays between UPS and Etsy. There's some maybe risky but interesting stuff at the top of that high ROR put scanner. But this is what we've got. This, above all else, is what we like headed into the week. We are set up for a very, very nice base profit, but lurking futures are down 0.6%, so we could be in for a red Monday. But with that red Monday, look at this out to the right. The most important thing and the reason why we run what we run, we've got some big cushions. We would need some 3% plus drops across the board for us to lose money on pretty much every single position that we have open. And because of that, we are not scared of this. And then the best part about this week, just remember, Friday the market is closed, 4-day week, and you don't have to spend your Friday afternoon staring at the market getting ready to roll your positions. Things should be much, much smoother, and you get a free day, right? Normally we have to wait 5 days to get our profits, but we only have to wait 4 this week, and then we can roll and then talk again maybe next Sunday. I'm not sure what my Easter plans are, but we'll figure it out together. But with that said, I think I'm really, really happy and optimistic about what we have set up. If we get some bounces off DraftKings and Fubo, this 5,000 base that we have, if this goes to like 17.5 and we realize max profit on both of these and get the bounces that we're looking for, we go from a nice 5,000 week to an 8,700 week, and all of a sudden we are just absolutely cruising from a profit perspective. So that's how quickly these things could all move together. We really just want to make sure that we eliminate the big red weeks that we had at the beginning of the year and the strategy with the more conservative strikes, the big cushions that we have right here, and the smaller position sizes off the bat on some of these things are going to help us accomplish that. We already have proof that they did help us accomplish that, as we only lost 3,800. And if you've seen our performance from mid-March on, that should be nothing to make back. And if you look at 2021. It should be nothing to make back. That's a very, very easy amount of money to get back. And it's been a tough market. We've had some tough drops in the stock, but I love where we're set up. I think we're set up for a good week, and I hope that the time we talk to you next week, we've got some good news. We're back in the driver's seat on a couple positions, and we can keep the line moving. So for those of you who have kept watching, this has been Hourglass Trader, where as time passes, we make money. Thank you guys for tuning in, and hopefully we talk again same time next week with more money than we currently have right now.